So, regularly monitoring and reviewing portfolio performance is, honestly, just critical to achieving your investment objectives, maintaining the right risk levels, and adapting to those ever-changing market conditions. Evaluating key performance metrics really helps investors spot underperforming assets, optimize their asset allocations, and make those informed decisions that can improve overall portfolio performance. Alright, let's talk about some key concepts in portfolio performance monitoring. First, the importance of monitoring portfolio performance can't be overstated. When it comes to assessment of investment objectives, you want to evaluate whether your portfolio actually lines up with your goals, like income generation, capital growth, or maybe risk management. Next, risk tolerance. It's essential to make sure your portfolio's risk exposure stays consistent with your comfort level and financial capacity. And finally, market adaptation. It's important to review how changes in market conditions affect your portfolio's performance, and then adjust your strategies accordingly. Now let's dive into some key performance metrics for portfolio evaluation. First up, total return. This measures your overall portfolio performance, including both income like rents or dividends and capital appreciation. The formula goes like this: ending portfolio value minus beginning portfolio value plus income, all divided by the beginning portfolio value. Moving on, risk-adjusted return. This metric takes portfolio risk into account when evaluating returns. Basically, higher returns with lower risk show better performance. A common measure here is the Sharpe ratio, which is calculated as return minus the risk-free rate, divided by portfolio volatility. So, let's talk about portfolio volatility. This measures the extent of fluctuations in your portfolio's value over time. Basically, lower volatility means your performance is more stable. Now, when we do a benchmark comparison, we're looking at how your portfolio's returns and volatility stack up against indices like the S&P 500, REIT indices, or even bond market indices. Next up is income yield. This evaluates the income your portfolio generates relative to its total value. The formula is pretty straightforward: annual income divided by portfolio value. It's a simple way to see, just how much income your investments are actually producing. Now, let's discuss the role of performance monitoring. First, it helps you identify underperforming assets. Those assets or asset classes that are consistently yielding below expected returns or benchmarks. Then you can rebalance allocations, which means adjusting your portfolio weights to realign with your target allocations and reduce any risk concentration. And finally, performance insights enable you to make informed decisions, refine your investment strategies, improve asset selection, and really enhance your portfolio's resilience over time.